Welcome to CEO Money. I'm Michael Yorba. Thanks for joining us. Michael Gilburd, President of ValuCorp, is on the show with me today. Michael, welcome to the show.
Well, thank you very much, and thank you very much for having me back.
My pleasure. All right, now for a private placement, it's a very good idea to include a business valuation and or intangible appraisals. Take it from there. Talk to me what you're doing about what you're doing with these companies, how you help the buyers and understand what they're buying and help the sellers when dealing with the sale of their business.
Will do. So let me back up a bit, if I may. The key to any offering is making a good first impression. How do you make a good first impression so that you grab that investor says, wow, I want to learn more. Now we do it with PowerPoints. Everybody has a PowerPoint. They put together a PowerPoint and they hope that that does it. So at one end of the spectrum, you have too little information. You have maybe 8 slides and none of them really have meat. At the other end, you have 50 slides and they all have meat. It's almost as if you rewrote your private placement memorandum into a pitch deck. So what we recommend in a pitch deck is at the very beginning, what is the market? How are you satisfying the market? What is unique about the company that solves the need? Who is the management? Have they had prior experience, prior successes? And number 4, what I left with the last show, 4-4-40. Can the investor get 4 times their money in 4 years to create a 40% internal rate of return?
Got it.
So I like to see that on slide number 1. And then from there are things to do that will help create and hold that interest. So the first thing after that first slide is a clear statement of the product or service. Entrepreneurs get so involved in their own company that they almost assume that people know what they do based on their name, their logo, having a prior relationship with that person. So I recommend the short elevator pitch. You're in the elevator. Hi, how are you? Hi, how are you? What do you do? What do you do for a living? What would you answer? You would give them 1 or 2 sentences about what you do. Right. And that's the 1 or 2 sentences about your company. And from there, in your deck, I would go right to the business model. This is our business model. This is how we make money. And as advice, besides what's on the deck, is build your model and stick to it. So if you're a TV show, like America's Business Show, are you going to be a radio show? Well, why be a radio show when you have TV? Why not do that? You could always have the audio separately. So have what your business model is and then stay with that. Unless you have an investor that wants it different and they're putting in a lot of money, stick to your business model.
Right.
And with that, what is your marketing plan? How do you plan on marketing this business? And we'll get into some details on that, but it's very important from a marketing perspective. Who's going to use your product or service and why will they do that? What is so special about that? In this area, I like to put in comparable companies. So if I'm doing a social media company, which I am, I put in other companies like Facebook and Instagram and all the other public companies that I could find And what are they trading at and why? What are the comparables? How many users do they have? How do those users translate into market cap?
So trading slash valuation.
Yes,
Right.
and that goes into the valuation,
then
the
market cap.
comparables. So if one could say, and we'll talk bits and pieces until we get to the entire valuation. So one could say Facebook is trading at 22 times earnings or $1 per active monthly user. So which formula do you use? You use both when we get further on into the valuation.
Okay. Let's keep
So
today's conversation at a high level. We'll drill down in subsequent interviews to some of the details in there. Aside, that's obviously a longer conversation people can have from the video and contact you in person. But keep going. You've got my interest.
Oh, good, good. So how are you doing your beta testing? Are you doing focus groups? Are people using your product or services? Do you have testimonials? Is it working? And what does that look like?
Got it. I love this conversation with you. I really get to learn something. So please bring it on.
Oh, great. Okay. So I'm going to talk a little bit about the valuation now, and please ask me more about it later, or we'll save it for the next show. The biggest mistake that I see entrepreneurs make is they go out and they say $2 million for 20% of the company. Well, how did you get to that number? Well, we're going to sell 2 million shares at $1 each, and we're going to do crowdfunding. Okay, so how much is your company worth? They say, well, if we're raising 2 million for 20%, obviously it's worth $10 million. Well, not really, because what you're doing is creating a security that's not marketable. So securities that are not marketable are worth less than those that are. That's why companies go public, among other reasons. Mm-hmm. And also there's no control. So you have to take discounts for those too. So if you're saying 10 million, it's really 20 million, because those two discounts are usually approximately 50%. So you should know that when you're out there raising money. Now, when you raise the 2 million, and this has to do with projections, which we'll touch on a little bit, what happens to the 2 million? Critical that the deck quickly shows a slide on use of proceeds. You're going to get the 2 million. How are you going to spend it? Often forgotten, a necessity.
Really? Okay.
And
Seems
then
kind of common sense to me.
Oh, good.
Well, if I'm going to give you some money, how are you going to invest and spend my money? Would be the first question any investor, I would think, would ask. Would be the first thing anybody trying to put themselves on the other side of the table, which you have to, would think of. Like, well, they're going to want to know what I'm going to do with it, right? Are you saying?
And that's a very good point. That the pitch deck, as you prepare it, be thinking about the other side of the table. Who's going to see it? What are they going to think when they see that? Wow, this is great. Or, okay, ho-hum, I'm on to the next deal.
Right.
Let's keep moving.
Compelling.
So
I'm getting from you, it needs to be compelling all the way through. Am I right?
Okay. Yeah.
Okay.
Okay, so in the projections, is the 2 million enough? You've showed how you got to the 2 million, right? You have shown the use of proceeds. Now, is the 2 million enough to reach the goal? What's the goal? 4,440, remember? So we have to keep everything in sync so the investor says, wow, this company really has their act together. They understand the business of investing. besides understanding their own business.
Well said.
So when looking for a private placement, you may, and this is not as much a necessity as some of the other things, is to consider capital markets alternatives. So are you doing a private placement? Could you instead have enough employees to do an ESOP? Are you thinking about going public? If you are, is that reality? Are you taking the steps to go public? If you're talking that, oh, by the way, our exit strategy is we'll either sell or we'll go public. Most everybody says that. How about saying that you're taking the steps to go public now? You have books and records that show the actual auditability. I don't know if that's a word or if I just made it up. Auditability of your books and records, which takes us to the projection assumptions. So we got to the $2 million use of proceeds. We're saying that it's enough. Why is it enough? Because the projections will show that it's enough. Major flaw that entrepreneurs need to think about, and again, we're talking about the pitch deck, so we're just going to show the highlights. So I would show revenue for 4 years, costs and expenses for 4 years, profitability for 4 years, net profit after taxes. 4 lines. That's all you need to show in the deck. The next slide, which entrepreneurs often forget, the same thing for the balance sheet. Current assets, current liabilities, total liabilities, net capital. So those have to fall in line with the income projections that were shown. And then the next one is cash flow. In the event that your income projections are on the accrual basis, you want to show the cash basis and what that will look like.
Got it.
Okay. So that's really, how to do that pitch deck. Oh, and the last slide, which I just got one from a guy from one of the major banking. He said he had been at one of the major banking houses, and he sent me a pitch deck on his new business. Nowhere in the deck is his name or contact information. So the last slide, don't expect the viewer to make notes about who to contact. The last slide is who to contact. Name, phone number, email, maybe Skype, maybe whatever, so that you know how to contact them. So in general, that's how to do it.
Good. Well said. It's a great interview on what it is that we're doing. I appreciate that, Michael. Thanks for being a guest on today's show. We're going to dive deeper into each one of these things that you broke out all the way through. I took notes on everything, so we'll pick up where we left off.
I saw that. I was very flattered.
You're here for me to learn and for the rest of us, so I'm going to take you up on that. If you're going to open up to us, I'm going to learn.
Happy to.
All right. Thanks for watching CEO Money. I'm Michael Yorba. Don't forget, like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.